For more on how these latest cuts could impact the global energy environment, and maybe to say who's right, Guy or Steve, let's bring in KPMG Global Head of Clients and Markets, Regina Mayer. Regina, great to have you with us. Steve makes an interesting point, and you make the same point in the notes that I got, and that is that there is underproduction already. So how do these cuts actually factor in, and how does that impact the price of oil in reality?
Yeah, I actually like the conversation that you all were having, because I do think the market overreacted today. What OPEC Plus did today was really largely procedural. They've been underproducing 3.5 million barrels per day against the quotas that they have. So by cutting 2 million barrels per day, they're really just lining up actuals with production. What was interesting was the Saudi agreement to cut about 500,000 barrels per day, and the UAE and Kuwait also making cuts. They are the ones that have spare capacity, and they are agreeing to cut. I think that's because they want to drive the price higher. They were more comfortable with it in the 90s. They were looking for the Goldilocks oil price, and they'd like to see more high side from a price perspective. That's what I think happened today.
So can I just ask you for a point of clarification? You're saying that OPEC as a group, as the cartel, is underproducing by 3.5 million barrels a day. But in terms of the players that had oversupply or overcapacity, they are actually cutting. So isn't there an overall decrease in the amount of oil in the end anyway?
I think that we're estimating it's between 800,000 and 1 million barrels per day in terms of the actual cuts. But I think what the market response was way on the high side relative to what that actually means. I do wonder, and here's the thing that I think could be a kicker relative to what ultimately happens. The Saudis do seem to be indicating that they don't have spare capacity. And cutting by 500,000 barrels per day could be giving them the breathing room to try to rebuild their own stocks so that there is a little bit more of a global oil buffer. But you get different perspectives on what's really happening inside the kingdom.
How does this all play out for the Biden administration in terms of what they will try to do? We've already heard that they're going to release from the SPR. I'm not sure if that's going to have any sort of lasting impact on the price of oil, but the midterms are coming up, so the administration might, I don't want to say overreach, but be ambitious in terms of what they can do to offset, this cut.
There seems to be a lot of focus on this particular meeting with what the administration tried to do. So they definitely went out there to try to make an impact, and that's going to have repercussions in terms of what public sentiment might be. They're not going to be able to release SPR barrels on par with how much OPEC can cut. So that's not going to be a trade mechanism or a balance of trade mechanism that will end up helping. And we are seeing gas prices steadily increase at the pump in the U.S. So I think those will have potentially an impact on the midterms. And I think that's what we've seen the administration try to respond to, try to get on the front foot. But obviously, we've seen what the outcome was with OPEC Plus's decision.
Hi, Regina. It's Courtney here, and thanks so much for joining us. I actually want to go back to something that Steve said earlier, which I think was a really good point, where he said that there is these structural supply and demand constraints with energy. However, that has been the same when oil was significantly higher price than it is today. And I'm just curious what your response to that would be. So OPEC set aside with these supply demand constraints, where do you think oil should sit in there? Is it below where it should be?
I actually think that from a global supply perspective, we're in a lot better place than we were in February, March of this year when the war in Ukraine started. There was a lot of unknowns relative to global supply. And you think about what global stocks did during COVID, a lot of that oil production came offline. A lot of these long cycle investments were cut off as oil companies really just tried to survive the pandemic. And so it's taken quite a while for that infrastructure to come back into play. I don't believe that we're in the exact same supply-demand fundamentals that we were when prices were in the 120s. I really do think if you look at the 5-year average, which is something that I look at pretty closely, we're only about 2.5% outside of that 5-year average now, whereas we've been well below the 5-year average relative to both refined product stocks and global crude and natural gas supplies. And slowly but surely, the world's been building the supply back, and demand hasn't necessarily come online as robustly as we thought. Right? We're still seeing a slowdown in China with their COVID restrictions. There's fears about recession and what that might do to reduce demand long term. So I don't necessarily agree that the fundamentals have been the same, but we are still in a tight supply situation with the potential for demand to spike. And that means there's going to be more upward pressure on price in the short term, given those fundamentals.
How much upward pressure in price, Regina?
Well, I was interested because some of the analysts started to call that crude could end on average in the 70s this year. I thought that was interesting. I wouldn't have expected that 3 months ago. I don't think it gets back to triple digits. I think what OPEC Plus is looking for is where things are landing today, high 80s, 90s for WTI and for Brent, so that they can continue to monetize the natural resources that they have while the world will start to pivot away from hydrocarbons given this volatile and high price environment.
Regina, great to speak with you. Thank you. Regina Mayer of KPMG. Guy, let's say that the oil prices stay approximately where they are, gas prices stay approximately. Does that give the consumer enough relief, still breathing room, if you will, into the holiday shopping season?
Yeah, it should. But, you know, with that said, and you mentioned it earlier, right before our very eyes, gas prices are starting to rise again. But let's just play it both out. Crude doesn't go anywhere and gas doesn't go anywhere. I think people have gotten acclimated to current prices. So, as I've said 1,000 times on this show, never underestimate the U.S. consumers want to spend. They will do it, especially if prices stay stable. I just don't think that's going to happen. But with that said, if it does in terms of the stocks, I think this price is supportive of still higher prices in energy names.
Yeah, Bonawyn?
You know what? I think I'm going to take the other side of that. And I apologize, Guy. You're typically spot on here, and you probably are here.
Don't apologize for disagreeing with Guy. He's not the godfather of this show.
Guy is the godfather. And, you know, I think it's appropriate. He and Steve were playing polite, so I'm going to continue to play polite, and I'm still going to express my opinion. I do think, regardless of whether oil stabilizes here or not, the trends that you're seeing in rents, particularly in the multifamily sector of the economy, those continue to ratchet higher. And I think that those have the largest and most lasting impact on families' ability to spend. You look at credit card data and you go down to the auto sector, and you're saying that now people are spending on average about $1,000 per month in terms of their auto expense. I think there just comes a point where you're stretched beyond your capacity. And then thirdly, you kind of want to pour on increasing rates. Just at some point, I think there has to be some pivot. There's only so much traveling you can do. There's only so much consumption that can be had, particularly unless we continue to see upward inflationary pressure on wages. And that is going to be the end-all, tell-all sign in terms of what the Fed is going to do. So I actually think we are getting to a point where something has got to give and the cracks are starting to show.